A housing crash is coming as rents and mortgage rates skyrocket. I'm your host, Steven Van Metre, and thanks for joining me today. We're going to look at 8 reasons a housing crash may be coming sooner than you think. Let's kick it off with number 1, which mortgage rates in the U.S. climb to 5.11%, the highest since 2010. As a housing market which got a lift from historically low rates early in the pandemic, now seeing loan costs rising at the fastest rate in decades. Purchase prices have continued to soar, but sales are beginning to stall as buyers fight over a scarcity of listing. Some home shoppers are putting off their searches, unable to afford higher mortgage bills, making this the number 1 reason. And while springtime is typically the busiest home buying season, the upswing in rates has caused some volatility in demand. It continues to be a seller's market, but buyers who remain interested in purchasing a home may find that competition has modestly softened. Number 2 is the Fed, as the Fed raises the possibility of future mortgage-backed security sales in the FOMC minutes, threatening to drive mortgage rates even higher. The Federal Reserve eventually could resort to selling off mortgage-backed securities on its balance sheet, according to the minutes of the central bank's last strategy session in March. During the March meeting, the Fed officials reviewed the results of the central bank's previous efforts at shrinking its balance sheet between 2017 and 19. Amid COVID-19 crisis, the Federal Reserve purchased billions of dollars worth of mortgage-backed securities as part of its broader efforts toward economic stimulus. Now, I want you to keep in mind that these purchases of mortgage-backed securities have largely been credited with why mortgage rates were so low. As you see, the Fed is looking to sell them. The Fed has since stopped making those purchases, and mortgage rates have skyrocketed, and is signaling plans to shrink its balance sheet of mortgage bonds either through the securities maturing or prepayments. With mortgage rates increasing, the volume of refinances has shrunk considerably. In that context, some officials suggested it would be appropriate to consider MBS sales in the future to rid the bank's balance sheet of the securities. Any decision to that effect, quote, would be announced well in advance, according to the minutes. And that is the objective of the Fed, is to have a balance sheet only made up of Treasury securities, with them wanting to jettison all their mortgage-backed securities. Well, that means we could perhaps see mortgage rates in 6, 7, maybe even 8% range. Let's look at number 3 now, which is home buyers just got another grim new statistic. The average home prices in 11 housing markets now exceed $500,000 as prices continue to rise, suggesting that that alone could pop the bubble. Across the nation, home prices have soared during the pandemic as low home inventory ran to surging demand, and fervent competition ensued, and home prices have since gained 19.2% over the past 12 months, locking many would-be home buyers out of the market. But while prices have been rising most everywhere, some housing markets have become prohibitively expensive to some prospective buyers. A recent analysis found that a housing price benchmark once considered rare is becoming increasingly common, as average home prices top $500,000 and more in some cities. And all that's doing is pricing out prospective home buyers, and that alone could lead to less demand and the bursting of the bubble. But home prices could be getting even worse as we look at number 4. According to Zillow, what home prices will look like in 2023, revised downward forecast according to Zillow. Now, real estate researchers are dialing down their home price forecasts, but not the way you might think. On Wednesday, Zillow researchers released a revised forecast predicting that U.S. home prices would rise only 14.9% between March of 2022 and March of 2023. That's down 2.9 percentage points from last month, when Zillow said home prices would shoot up 17.8% over the coming year. And if Zillow is right and home prices do rise another 14.9% over the coming 12 months, it'd mark another historically strong year for home price growth. Over the past 12 months, home prices are up a staggering 19.2%, and each of those figures are outliers compared to the average U.S. home price growth of 4.6% per year posted since 1987. And if we were just to revert back to that trend, well, that means housing prices need to come down. Let's take a look at number 5, which is renters are so fed up with their home buying options that they say they'll rent forever. And that's according to a new survey by the Federal Reserve Bank of New York, which found that a majority of the 308 renters polled either prefer to rent or waiting for home prices to come down before considering a mortgage. And of course, that's the reason people start out in this world and rent, because they can't afford. And so while they're renting, what they need are rent prices to remain low so they can build up their savings and ultimately have a down payment to buy a house. And the annual survey found that the confidence renters have that they'll own a home one day fell to record lows, with half the respondents saying odds were 41% or less. That's the lowest confidence score the Fed has logged since it added housing market sentiment to the survey in 2014, which is a testament to how higher prices are having an impact on renters. The Fed study reflects growing pessimism among aspiring homebuyers, especially young homebuyers, which is necessary to drive the housing market higher as prices have ballooned over the course of the pandemic. More than half of the millennials last year say they didn't have enough in savings for a down payment on a home. And if you can only imagine, with home prices running at almost 20% a year increase, well, that means you've got to increase your home down payment savings budget by 20% a year. Very difficult to do, which is typically 20% of a home's cost per December 2021 Clever survey. Millennials and Gen Z, the former of whom are locked out of the housing market for years and the latter of whom are just entering it, are being outbid by older generations and even Wall Street investors. That's on top of inflation making everything more expensive, while the pandemic erodes the savings of Gen Z and millennials more than anyone else. And that, of course, will take us to number 6. But before we get there, if you're concerned what a housing crash could mean to your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up there in the corner and the description below. You'll be glad you did. Let's take a look at number 6. For renters, though, it's going to get worse, putting even more pressure that they won't be able to afford a house. Rent increases by nearly 20% across the U.S. What renters need to know, as experts recommend spending only 30% of your monthly income, which could be a challenge with inflation on housing, but that goal may be unattainable for many renters. And rents have gone up 17% nationwide year over year, with February marking the 7th consecutive month of double-digit price growth for studio and 2-bedroom apartments, according to a recent report from Realtor.com. And that alone will just add to the pressure that renters face and their inability to get into the housing market if they can't get their down payment as home prices rise and rent prices rise to cut into their savings. And the median rent for an apartment reached $1,792 in the 50 largest metro areas, increasing 4 times as fast as pre-pandemic rent prices, according to the report. Overall, rent prices are growing faster than incomes, which is a key problem, leading to the affordability issues for renters across the country. Other economic factors like skyrocketing inflation are also putting pressure on household budgets across the country, and wages aren't keeping up with rising costs. So if people can't get out of their apartments because prices are rising too fast, well, that will bring prices down. But as that article mentioned, number 7 is wage growth. As Americans are still getting larger than usual raises, but the wage rallies are starting to slow in some cities. The good news, working Americans are still seeing wages climb at a historic pace, as average hourly earnings rose by 13 cents or 0.4% to $31.73 in March, accelerating from the mild gains seen through February and continue the trend of above average wage growth. With job openings and quits both near record highs through February, businesses continue to boost pay in hopes of attracting and keeping workers. But those wages, as you see, are not growing as fast as housing prices, and that alone could add to the story of why prices are going to crash. Yet the wage rally is starting to diverge. The new Beige Book reports from 12 regional Federal Reserve banks published on Wednesday revealed just how labor markets differ across the U.S. While employers in some cities and the regions around them are preparing for another round of larger than usual raises, others are starting to rein in their pay hike plans. And that takes us to our last number 8, which is jobless claims slipped to lower last week amid tight labor market because if things slow down due to high prices, well, that means unemployment claims are headed up, and that signals bad news for the housing market. As claims continue to hover on half-century lows as the economy recovers, and what do we know when things are near their lows? Eventually, they go higher. Initial jobless claims are proxy for layoffs decreased 180 to 184,000 last week, according to the Labor Department. On Thursday, jobless claims have hovered around half-century lows since 2021 as the labor market continued to improve during the economic recovery. The 4-week average for claims, which smooths out volatility, nudged up to 177,000 1,250 from a week earlier. And competition for workers has driven up wages, especially in industries facing the worst shortages like leisure and hospitality. Average hourly earnings grew 5.6% in March from a year earlier, still falling way short of the housing gains. Still, that gain is less than the 8.5% increase in consumer prices over time. And as you can quickly do the math, which means workers are not being able to keep up inflation and certainly not keeping up with housing price inflation, meaning a housing crash could be coming sooner than we think. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.